WILLIE, the global currency reset has begun, with many sides, all in progress. The United States has 3 requirements in returning to the gold standard. They will be extremely difficult to achieve. They each serve as essential requirements in a criterion. All 3 are urgently needed. The challenge is formidable for the nation to remain as a leading player in the global economy. The United States stands alone in volume of national debt. Many place the blame on the social net like welfare, social security, and other measures. However, the biggest element is clearly the military budget, hardly for defense in the last 2 decades. As CEO Jack Ma of Alibaba stated so succinctly, the US government has spent $25 trillion on the military with nothing to show for it except decayed infrastructure and global animosity for its aggression. A major item in recent years for the deficits has been Medicare, which is full of fraud and waste. Another major item is the raft of pensions like for government service, judicial service, and military service. Requirements for the gold standard eliminate the $21 trillion US government deficit, source 10,000 tons gold to support the currency, reindustrialize to work down $600 billion trade deficit. Back in 2017, US President Trump commissioned a study to verify the status of the US gold reserves. He and Vice President Pence, who led the study, were shocked to learn that the Fort Knox gold had been stolen. Of course, such a discovery never reaches the national news in broadcast or printed form. Thus the long delay in any conceivable effort to set up the $1 trillion infrastructure program promised during his campaign for office. The gears switched to locating and rescuing the stolen gold, with dirty fingers identified for ex-presidents Papa Bush and Bill Clinton, along with the Wall Street crowd of criminals led by Robert Rubin. Rumors are ripe that the gold has been recovered, which also never reaches the controlled news networks. The eager await currency reset has begun, with many sides, all in progress. The United States has 3 requirements in returning to the gold standard. They will be extremely difficult to achieve. They each serve as essential requirements in a criterion. All 3 are urgently needed. The challenge is formidable for the nation to remain as a leading player in the global economy. The United States stands alone in volume of national debt. Many place the blame on the social net like welfare, social security, and other measures. However, the biggest element is clearly the military budget, hardly for defense in the last 2 decades. As CEO Jack Ma of Alibaba stated so succinctly, the US government has spent $25 trillion on the military with nothing to show for it except decayed infrastructure and global animosity for its aggression. A major item in recent years for the deficits has been Medicare, which is full of fraud and waste. Another major item is the raft of pensions like for government service, judicial service, and military service. Requirements for the gold standard eliminate the $21 trillion US government deficit, source 10,000 tons gold to support the currency, reindustrialize to work down $600 billion trade deficit. Back in 2017, US President Trump commissioned a study to verify the status of the US gold reserves. He and Vice President Pence, who led the study, were shocked to learn that the Fort Knox gold had been stolen. Of course, such a discovery never reaches the national news in broadcast or printed form. Thus the long delay in any conceivable effort to set up the $1 trillion infrastructure program promised during his campaign for office. The gears switched to locating and rescuing the stolen gold, with dirty fingers identified for ex-presidents Papa Bush and Bill Clinton, along with the Wall Street crowd of criminals led by Robert Rubin. Rumors are ripe that the gold has been recovered, which also never reaches the controlled news networks. The eager await confirmation.
Only a handful of stocks will survive the coming financial collapse. Trump's protectionism will cause financial collapse. President Donald Trump's protectionism could have some benefits for the real economy in the short term. But those same benefits will crush stocks, triggering a financial collapse. The coming financial collapse won't affect all stocks equally. Some will fare much better than others. To see which ones, keep reading. But before we consider what those stocks might be, it's important to understand how the virus of financial collapse was born. Main Street wins and Wall Street loses amid financial collapse in the post-Cold War era, 1990 onwards. The economy has tended to favor Wall Street at the expense of Main Street. Is it any wonder that the American middle class has lost the importance and dominance it once enjoyed? It was the victory of finance over industrial America. From being tools of the economy, investment banks and financial services became its masters. Encouraged by free trade treaties and globalization, mines, steel plants, car factories, and appliance manufacturers moved production and jobs overseas. This increased unemployment and underemployment in the United States and another Organization for Economic Cooperation and Development (OECD) countries. Ultimate goal of business has become ever more to please shareholders. The overriding concept in the economy for the past 25 or so years has been to lower the cost of labor to improve earnings. Look at this chart of the Dow Jones Index since 1989. The Dow moved ever higher until it reached the subprime crash. And the subprime crisis was the inevitable result of the overriding importance of finance in the economy. The even sharper subsequent climb reflects the fact that the subprime crash failed to teach any lessons. To achieve it, corporations and politicians have encouraged free trade. Unfortunately, it wasn't so much the free trade among equals that they encouraged. It was free trade with countries with an abyss of difference in average wages. That may not have been the original impetus for the North American Free Trade Agreement, NAFTA, but its effect was certainly to put pressure on U.S. auto workers. Outsourcing gone mad. Free trade and shareholder interest also drove companies to ship production of just about everything to China. Such is the extent of the malaise that even China has become too expensive. For example, many clothing companies have been moving more and more production to Bangladesh, Vietnam, or Pakistan, where labor costs can be even cheaper than China. The Trans-Pacific Partnership (TPP), which President Trump scrapped, would have emboldened more businesses to up the outsourcing ante. The TPP would also have further enhanced earnings, putting on the afterburners on an already overheated stock market. Granted, Trump's tax cuts have already achieved that. But his protectionism could send the markets into an out-of-control stall. That's because protectionism, understood as an effort to bring jobs and manufacturing back to the United States, will ruin the very thing that fuels a bull market, earnings per share. Granted, some companies, I'm looking at you, Tesla Inc., Nasdaq, Tesla, and maybe even Amazon.com, Incorporated, Nasdaq, Amazon, are able to sustain gravity-defying valuations without even a hint of earnings. But they are rare examples that exist only in certain industries, which both the zeitgeist, the sign of the times, and investors have decided will form the foundations of the future. Eventually, however, the lack of earnings does have a way of catching up. Earnings going down. Trump's protectionism, however, will reduce earnings for many companies, even if revenues increase. Indeed, American workers won't suddenly get paid more. They will probably face greater pressure to accept lower wages, because companies will have to hire more of them and fewer Mexican or Chinese people. This is not just a matter of employment and earnings. It's also market competition. Apple Incorporated, Nasdaq, Apple, by far one of the biggest ever winners on Wall Street, faces a real threat, a financial collapse all on its own. Having made its fortune producing its world-famous and coveted high-end products such as the iPhone, iPad, and iMac in China and, indirectly, Malaysia, it now faces the prospect of transferring production to U.S. soil or having its products heavily taxed on entry in the United States. How many iPhones do you expect Apple to sell if its retail price doubles? Even with tariffs, products from Apple's Chinese and Korean competitors could cost less. And even if they don't, Apple is staring at the prospect of a massive drop in both revenue and earnings. Countless other companies and stocks will face similar dilemmas. That's why the markets are not just marching toward a crash, but a wider and systemic financial collapse. Which stocks will the financial collapse spare? Not all stocks will suffer. Some will continue to thrive, and they are the ones related to companies that never participated in the kind of Apple or Nike-style globalization. In a word, think aerospace and defense stocks, the ones related to companies like Lockheed Martin Corporation, NYSE, LMT, General Electric Company, NYSE, GE, Boeing Co., NYSE, BA, and even United Technologies Corporation, NYSE, UTX. That's because their overseas production more than often addresses local market needs, making them less vulnerable to retaliatory tariffs. The stocks cited above are related to companies that upheld a skilled and well-paid workforce in the United States. Lockheed Martin, Boeing, and others like them have maintained the bulk of their engineering and production in the United States. Moreover, given the massive cost, management complexity, and the variety of skills needed to design and build a new airplane, the aircraft market has become ever more saturated. There's little room for new players. And even then, such as the case of Bombardier, Incorporated, C, BBD. B, it's only for niche market segments. Moreover, aerospace workers in the West, like other types of manufacturing, compete on equal and well-paid terms. Earning margins depend more on delivering the product the customer wants, and each airline is different than price. Surely, aerospace and defense stocks will suffer in a financial collapse situation. But they won't suffer as much as others. More importantly, they literally have the wings to start flying again. Stock market crash ahead? Even the big banks are turning bearish now. 3 reasons why a stock market crash could be likely. We have been talking about a possible stock market crash for a while in Lombardi Letter. Long-term readers have been warned several times. Our reasons for these calls are very simple. We've listed a few of the biggest ones below. First, stock valuations are too high. They tend to adjust over time and fall back to their historical averages. If valuations do see a reversion to the mean event, we could see a massive stock market crash. Second, stock markets are reliant on economic performance. The U.S. economy could be on the verge of losing its momentum. After the financial crisis, easy money gave the economy a boost, but that's being taken away. With it, the U.S. economy could face headwinds and the stock markets could see a sell-off. Last but not least, risks in the global economy are increasing. Everything on the surface may look good, but problems are brewing underneath. Global worries could cause a stock market crash as well. Big banks turning bearish on stocks now, the big investment houses are sounding the alarms of a stock market crash ahead as well. We are not surprised by this, but it's very interesting, to say the least. For instance, Morgan Stanley, NYSE, MS, came out with dire warnings recently. Regarding the momentum in the market, it said in its notes to clients that there's a breakdown in both legs of momentum. It warned that this phenomenon could be a trigger for a significant market correction. Source: 2 stock market broken legs set stage for significant correction. Morgan Stanley, Market Watch, August 9, 2018. Morgan Stanley talked about Apple Incorporated, Nasdaq, Apple hitting the $1 trillion valuation. Rather than seeing it as a sign that says everything is great, Morgan Stanley said it sure sounds like a ringing of the bell to us. Source: IBID. Bank of America Corporation, NYSE, BAC, another notable financial giant in the U.S., came out with an outright bearish call to action recently. Bank of America literally called for shorting the high-flying FAANG stocks, that's Facebook, Incorporated, Nasdaq, FB, Amazon.com, Incorporated, Nasdaq, Amazon, Apple Incorporated, Netflix, Incorporated, Nasdaq, NFLX, and Google parent company Alphabet Inc., Nasdaq, Goog. Source: short FAANG stocks, BOF says, Bloomberg, July 28, 2018. While we are at it, know that Morgan Stanley and Bank of America aren't the only big banks that have bearish calls on the stock market. Other major banks have done the same. The list keeps on getting bigger every day. Why do big banks matter? You see, institutional investors, those who actually have a lot of buying power and can move the markets, tend to listen to the big banks' advice at times. If the big banks are turning bearish and calling for a stock market crash of sorts, it could cause institutional investors to panic and sell. As a result, all of a sudden, we could have a major sell-off at hand. Dear reader, my goal is not to scare you. All I am saying is, don't get too complacent. Don't forget, complacency is very dangerous. Don't just look at the bullish case for the stock market. As key stock indices have soared immensely since their lows in 2009, the U.S. economy is facing headwinds, tensions in the global economy are rising, valuations are extremely high, and now the big bank sentiment is turning. It might be time to pause and reflect. I believe capital preservation is very important these days. It doesn't hurt whatsoever in the good times, and in case there's a stock market crash, it protects investors.